Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. Today we've got a guest who doesn't need much introduction, but we're going to give him one anyway. We've got Mr. David Belle back on the show. In my opinion, one of the greatest macro minds out there, and of course the founder of Macrodesiac, which we'll talk about towards the end of the video. Thanks a lot for coming back on, David.
Cheers, mate. Thanks for having me as per.
No, it's an absolute pleasure. And I thought we could really kick things off. There's been a lot going on the macro. There's been a lot going on in all markets, and right now markets are rallying. So I thought we could kick things off with maybe your opinion on perhaps why markets are rallying, and then what end do you think this comes to?
Well, I think JP Morgan summed it up quite well in a note from, I think it was the 2nd, maybe. Might have even been from yesterday. But basically they've said, look, it's down to short covering. Obviously that happens. There's been a lot of shorts in the market over the past couple of months, and as rate hikes start to get introduced and we become more acclimatized to higher rates, there comes a point when it's less of a shock, and I think that's what's happened. They said that many believe that the Fed recenters from inflation to growth, and if growth continues to disappoint, that brings the end of the tightening cycle earlier. So we're looking at a growth shock here, basically. And then they said better than expected earnings from mega cap tech in an environment that looks like Q2 will be the worst quarter of the year. They also said that the retail bid appears to have returned, which I think is actually quite a bad sign, because if you're a retailer making money, it means that they need to get carted out at some point. It says a ton of money is on the sidelines, so light volume and low liquidity. So it's basically a low liquidity rally as well.
And that's dangerous. You want to see volume behind a rally, not low liquidity that's retail driven.
Yeah, it's 100% a bear market rally. I mean, if you look at bear market rallies before, it exhibits pretty much all of the same attributes. Things are shit. There's not many intentful or motivated buyers. And I don't really like that word, but you can tell that from the volumes, basically. There's no one that is really pumping it. I think a lot of it's to do with pensions, automated buying from pensions, people who might have automatic contributions through their workplace. It's not going to go into cash, it's going to go into assets. And in a low liquidity environment, that is an automatic bid, basically. And then JP Morgan continues to say at some point that money on the sidelines is pulled into the market, but many investors think we need to retest and make new lows. Look for a flush day with VIX through 40 and S&P down 4 to 5% as part of forming that bottom. So that's quite hefty. That's implying about a 400-point move back to the downside. No, sorry, less than that, 200-point move. Maybe a little bit more, 230, 40-point move back to the downside. And then lastly, they said, in terms of tech outperformance, if we have seen the highs in yields, 3.47 on June 14th on the US 10-year Treasury, and we're going to be in a low growth environment, then mega cap tech is arguably the best long, irrespective of the shape of the yield curve. And the reason as to why they say that is because if yields are lower on the 10-year, that implies a lower risk-free rate of return, and discounted cash flow models are based on that 10-year risk-free rate. So the lower the yield on the discounted cash flow model, the better the prospects or future growth of cash flow of growth stocks are. And growth stocks, at the end of the day, tend to be mega cap tech. If you consider Amazon, for example, their retail arm doesn't actually make much money at all. I think it actually might be at a loss. So if it can imply that future cash flows are discounted more currently, then the stock price will likely go up. Obviously, there can be things overriding that in the short term, such as the macro backdrop and whatnot, where it kind of makes that a little bit negligible. But over the longer term, that is generally how mega cap tech stocks outperform, I guess.
Yeah, because markets are forward looking. This is the thing that people have got to remember. So I always get the question, okay, well, why on the bad news are we rallying? Well, what you've got to understand is that the bad news has already kind of been priced in to a degree. And then when you actually get the news, you'll often see things go in the opposite direction. So JP Morgan are really saying, okay, this is very much a relief rally, but there are long opportunities there to be had, essentially.
I think they're kind of playing both sides of the market. They're saying that, look, we can expect maybe a 4 to 5% flush. Personally, I would double that.
Yeah.
I think we go about 10% lower, maybe even more. I don't think the Fed are near the neutral rate. And
talking about the neutral rate that they've got priced around about where they are now. And you'll be the perfect person to ask on this. Neutral rate, is that where they see inflation over the next year, which is around about 2% plus 50 basis points, which is where they're kind of saying they are now? Is that right? I mean, the sort of ballpark there.
So the neutral rate is basically where they see that employment isn't affected by the raise in interest rates. When they turn and become restrictive, that means that employment basically goes up, and this is according to obviously full employment measures and the natural rate of unemployment. Excuse me. So that's basically where the neutral and restrictive rates come from. There might be some denial of unemployment having an effect on inflation, because the Phillips curve relationship has probably deteriorated quite a lot since the 70s and probably dispelled as well in the 80s. But it's still likely that, you know, if you have lots of people unemployed, prices will have to come down because demand's just not there. So yeah, there's definitely that factor to kind of take into consideration.
And this is the thing with the Fed where they currently are. You know, they are moving into restrictive territory at the moment. You know, people have took the 75 basis point news and they've kind of gone, okay, well, we're not going to get another. That's the kind of harshest hiking out the way. So markets are kind of now going, okay, we can maybe look to get away from that. What are your thoughts on that?
I'd actually disagree with that.
Yep.
I think we have to go back to what the Fed's mandate is. What's number one on their mandate?
Inflation.
Price stability.
Yep.
Yeah. And people that are saying, oh yeah, the Fed can just not, you know, can stop hiking now, or you know, the Fed is going to reach the end of the tightening cycle nice and quickly. They're saying that in the context of there not having been this level of inflation before. And so they're just looking at it from the perspective of, oh, everything's really bad. So, you know, like in other times, they'll just cut rates again. Well, no, the other times over the last decade, inflation hasn't been at nearly double digits.
Yeah. This is what people are missing.
You know, but it's literally bang obvious, because you'll see it on Twitter. In the next tweet, they'll be complaining about the price of something, or saying how, oh, blah, 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 is wrong for saying that inflation's coming down. It's like, what are you talking about? You're just talking shite. Do you know what I mean?
Yeah, no, absolutely. This is when people are comparing, relating things a little bit to the crypto market. You know, you always see people comparing prior time periods with where we currently are. Now, there are some comparable time periods that have elements of comparability about them. But the Fed's told you consistently, look, we're going to fight inflation, and we're going to do that through rate hikes. So they're going to continue to hike rates. What have the effect of rate hikes been so far? Now, markets, you know, we spoke about this relief rally a little bit off camera. Essentially, they're going, okay, well, somehow by the end of the year, we've priced out around about 50 basis points in interest rate hikes. So markets are going to get that bid. Right at the start of the video, you spoke about short sellers and this kind of short squeeze that's taking place. I don't know if you saw the ETF that's short the NASDAQ, but it had, I think, a record inflow since inception, just before this rally actually took place. So you've had short squeezes getting squeezed. You've had people trying to reprice markets and look to allocate capital potentially back in. We've spoke about the low liquidity of it. And we've also spoke about the fact that, look, okay, people may be saying rate hikes aren't going to be as harsh, but they're still going to be pretty bloody harsh. Like, this is what, if markets are driven on liquidity, what's the bullish outlook for a market that's driven on liquidity, driven by cash, continuing to have that liquidity drain from it? If that makes sense. Lots to unpack there.
You can't imagine that it's going to be too good, you know. It was pricing cuts, it was pricing hikes out, but now it's gradually started ticking back down again. So that's kind of showing that the market's thinking, maybe they aren't going to tighten, cut as soon as we kind of first thought.
Yeah, and that leaves a pretty bleak outlook, I'm afraid. And you've got to remember, quantitative tightening isn't just them doing rate hikes. They're also looking to reduce the balance sheet, which is going to start, I think, quite aggressively in September. And there's been models priced within the last time they did that of markets seeing that further capitulation to the downside. So
Mm-hmm.
what are you looking at for the future? We've had this rally for the equity market. How far do you think we get? I mean, because there's definitely room for some more upside. But ultimately, the eventuality is, I think that, this does turn out and is revealed to us that we're right, and this becomes just nothing more than a bear market rally.
Well, I am preferring to play in the FX land at the moment. I'm sure Aussie yen, because that's my favorite for when things really start to change and some risk comes onto the table geopolitically. We saw it with Taiwan. It was down 500 ticks from my entry at one point. It's now rallied up another 200, but I'm fine with that because I understand that pair, the Australian dollar versus the Japanese yen, kind of does that. It's very volatile once there's geopolitical risk on the table. So I like to keep my stops quite wide on it. Do move it down a little bit so that I'm gradually realizing some unrealized profit, if that makes sense.
Yeah,
Once you
sort
move your stock
of.
down, once you move your stock down into profit, you're locking in that level of profit basically. So, but it's not realized yet. So, if it does come up, then you've realized it, but it's
Yeah,
not
of
realized
course.
yet.
Yeah. Until you get hit. Yeah, no, absolutely. Unrealized
Um,
profit.
yeah, that's it. And yeah, I'm finding that the volatility in FX across the Asian currencies is ticking up quite a lot. I think
Yep.
there was a big old move in dollar Thai baht the other day. I think it was last week, maybe the week before. And these kind of things are good because it then says to you, oh shit, there's something happening, and all the others start ticking off. And there's a really interesting relationship going on at the moment with the dollar and the yen, because we've seen the yen be so weak for the last, well, year, I guess. But recently, the dollar and the yen are kind of switching places in terms of risk off flows. So, especially with this Taiwan kind of tension, what you tend to find with the yen is that investors, so Japan has a massive foreign investment position, a net foreign investment position,
Yep.
where they invest in loads of different foreign assets because they make up carry, basically higher interest rates elsewhere, lower interest rates in Japan. So they make up carry off across loads of different assets. But when things start happening in that kind of region, so it happened with Fukushima when the nuclear power plant melted down, they have to repatriate yen. And so that leads to a yen bid. And the same happens when there's geopolitical tensions in the region. So the Taiwan stuff, you've got a kind of two different things going on there. You've got China's economy slowing, which causes the Australian dollar to weaken a bit. But then in the very short term, and by very short term, I mean a couple of days, a week, you have that yen inflow that occurs because it's specific and proximal to that region, Taiwan conflict, that is. And so you've got the broader macro theme that you can play against, but also then you've got the counter currency, which experiences a short-term flow. And that's why I love FX so much, because you can really create a story for both sides. And sometimes you don't even need a story for one side. But when you get a story for both sides and it's very clear, that's when you can get a really quick move, and it makes things basically easy.
Yeah, there's been a lot of quick moves actually taking place in the FX market. The dollar ran parity with the euro. We're now seeing a rest for the dollar, and I think this is also supporting the equity market. So you're mainly trading FX right now because it's the market to be in. I've heard a lot of people say that right now, FX is almost like the new cryptocurrency market because the moves are
Yeah.
there, the volatility's there, and you've got the volume behind it. And this is one thing that you really impressed on me. It is just how tethered all markets are to the FX market. you know, the FX market is kind of like that canary in the gold mine, or in the coal mine, I should say. And this is the thing, you know, we're seeing major moves in FX. You know, what would you say the sort of effect of the FX market is having on the crypto market and the sort of equity market right now? Would you say it's sort of draining the liquidity out of it? Would you say that it's warning of something, or is there any relation you can make there?
Well, I think what's more important is rather than look at the direction of the dollar specifically, because the dollar rules everything at the end of the day.
Yep.
We have to look at the cost of borrowing dollars. And you can do that by looking at 3-month dollar LIBOR. LIBOR is probably going to be gone by the end of this year, but it's still being used, and it is still, you know, a legacy measure of dollar funding costs.
What is the LIBOR quickly? It's just, you mentioned a legacy measure of funding cost. So are you referring to the rate that you can borrow dollars at? What are you referring to there?
So yeah, that's the rate at which banks borrow dollars from each other on the interbank. So to be able to fund
market.
Kind of, not really the repo market. No, it's more generally. So yeah, it's the London interbank offered rate, and it's going to change, or it is changing, to SOFR, which is the secured overnight financing rate. But basically, it's the price at which banks borrow dollars from, and if you can imagine that if the rate's going up, it means banks want to hold on to their dollars.
Yeah.
Which means that the price of the dollar is going to increase as well. This is actually probably the main driver behind the direction of the dollar. People think it's just people just buying dollars and all that kind of thing, but it's down to dollar liquidity, and that is what, you know, basically liquefies or deliquefies the dollar markets.
Yeah,
is the price at which banks can borrow and lend dollars at.
Yeah, because this is one thing we had. I mean, I'm sure we both saw them on Twitter, and you know, look, everyone's got an opinion on markets, and that's how it should be. But I think people didn't inherently understand the reason why the dollar was going to catch such a bid. If you're upping interest rates, you essentially are saying, look, you need more dollars to cover the debts that are already out there. So inherently, it drives the demand for the dollar. That's just in a sort of within the US and also around the world. You know, everybody owes dollar debt, basically. And this is the thing, and this is what we're trying to sort of work out. So the LIBOR market is essentially telling you that people are holding on to their dollars, and the dollar's becoming more expensive to kind of lend out. What drives markets? Money.
Yeah,
you know,
dollar,
and this is the thing.
exactly.
And we not just got it going on in the US. We've had the Bank of England. We had Bailey come out and make some pretty strong comments in regards to what was he looking at? A 2-year recession or something along those lines?
Yeah, I think he was talking it up, though.
I think so as well.
I think what the Bank of England does a lot is they do surprise people, but also now if they over-egg recession, I do think recession will come, but I don't think it will be as drastic as they're talking about. But now, you know, if they walk back, like he said, inflation will be at 13.3% in October.
Insane.
There's a chance of that. But I also think now that if it misses and it only goes to, and I say only very fucking liberally there, if it only goes to like 10%, then that's politically, it's bad, but politically from where they've estimated, it sounds good.
Yep.
They don't mind in this situation being deemed uncredible because it still makes them look good, if that makes sense.
Yeah, it makes them look like they've really sort of put the boot in and given inflation a kick, and what they're doing is working, even though 10% inflation by all accounts is totally ridiculousness. And this is the thing. So you mentioned recession there. I mean, I've got so many questions I could ask you. You know, are we in a recession? I want to ask you that question first.
Well, yeah, I think you can see the lead up into recessions. You know, we've had a very, very sharp decline in house prices.
Yep.
In the US, anyway, it's probably the easiest place to view it.
And
I wrote a piece, and China, of course, yeah. I wrote a piece back in April, I think, saying my head's not turning away from the housing market, and the reason why is because the sector with the worst performance year to date at that time was house builders. And if you look over history, house builders are very, very closely correlated with the Case-Shiller year-on-year home price index. So what we can start to expect is for home prices to come down because the house builders ETF had collapsed basically.
Yeah,
I think it's down like.
I think you actually showed that in the last
Yeah,
video that we did together.
yeah, most probably.
Yeah, for sure. You know, this. So you think we are in a recession because did you see what the US or the White House came out and said in regards to, you know, a recession is not defined by 2 negative quarters of growth?
Yeah,
Unbelievable.
which I agree with. No, I do agree with that.
Really? So what metrics are you looking at? The employment market, or what metrics are you looking at to kind of indicate and signal? Yeah.
Because what you could argue is that okay, so we have one period of minus 0.1% growth. Next period is minus 0.1% growth. Is that a recession?
I mean, you're way more educated on this subject than I'll probably ever be. But I've always sort of thought of a recession as 2 negative quarters of growth. I've always thought that was the term, or that was the kind of signal that told us, look, we're in a downturn. And them changing the name, I mean, a recession was called a depression back in the 70s. And then before that, it was called a panic, I think, in the 30s. And they constantly changed the name. So I mean, that's really interesting that you don't actually think we're in a recession.
I think it has to show up a little bit
across
more
the board.
broadly.
Yeah. No,
so you really have to see those like double-digit unemployment numbers. Of course, you know, any increase in unemployment isn't a good thing. But we really have to see an increase in those unemployment numbers, a sustained increase, the same way that they want to see a sustained decrease in inflation.
Yep.
You have to see the fucking reds. You have to see the headlines saying, you know, there's been 10,000 repossessions of homes, shit like this.
Yep.
You see what I mean?
Yeah.
Because I don't think it's sufficient these days just to say, oh yeah, 2 quarters of negative growth. Because where do you define a recession? You said that you wouldn't define a recession necessarily as 2 periods of growth at negative 0.1%, because it's not that bad. So when you start to get to numbers like that, it becomes subjective straight away. Because if you wouldn't define a recession at negative 0.1%, might someone else?
Yep. I mean, technically, I would define it as a recession, but 0.1%. What you're saying, I think, is an excellent point. You know, it's got to be more broad than just. I think you're onto something there. I've not really thought about it like that, to be honest. But you would say that this isn't a recession. And can we talk about unemployment quickly?
Sorry, can you see it there?
Yeah, I've got you.
So, you know, if we look here, we've got S&P 500 in orange, unemployment in white. Unemployment bottoms out here in 99 in the dot-com bubble burst because interest rates are higher. Unemployment increases again. You know, 2003 we have the S&P bottoming out. Unemployment starts ticking down again. S&P increases again. The same 2007-8. So do you see the relationship there?
Yeah.
Same in. So it's all down to interest rates. And I guess if you want to overlay interest rates here.
And do you think we're going to see a strong uptick in unemployment?
Yes.
We're seeing the layoffs absolutely roll in at the moment. We saw it largely with the tech sector, and now it's sort of going. I mean, was it Credit Suisse recently? They've laid off more staff. You know, it's across the board right now.
Yeah, the banks are. But yeah, I think this gives a good display of the relationship between interest rates and unemployment. Like if I take S&P off there, you can kind of see that.
Yeah.
So unemployment's bottomed out. The rates have started going up, and then you know we have a recession that increases it. So it's kind of symbiotic almost. You should soon start to see the unemployment rate tick up, in my view.
Yeah, and
it's astounding that it's at 3.6%. Quite frankly,
I think they're fiddling around with something. You know, and there's a lot of questionability, I think, in the area of unemployment. Something you've spoken about. Partition, it's at a low, right? Yeah.
If we look at the labour force participation rate, it's still not gone up to where the pre-pandemic number was.
Okay.
So it's at 62.2% now, and pre-pandemic, 63.44% of working age people in the US were in employment.
Wow.
So unemployment might be on a low, but there's this big gap between the working age who have completely taken themselves out of the workforce now.
Yeah.
So they've retired, or they just
they just decided not to go back to. Yeah, absolutely. And you know, this, I mean, ultimately, you know, we spoke about this being a bear market rally. These are all things that you should pay attention to. When you start to see that unemployment rate tick up, given the correlation that it has between markets and how interlinked everything is, you're going to see markets continue to capitulate. Now, you mentioned talking about a recession, that you don't think it's going to be a particularly harsh one. What are your thoughts on the recessionary period that we're moving into?
I don't think it's going to be a particularly harsh one.
I think it's going to be shallow.
In the UK relative to other places. That's probably the better line.
Okay.
If we think about the Eurozone, I think the Eurozone is going to have another debt crisis.
Yep.
They've suspended their deficit spending rules till March 2023. That is one major feature of the EU and the Eurozone. You know, it's slowly coming apart because they realize that you can't have the EU and the Eurozone together.
I agree.
Because the Eurozone breaks the idea of the EU. It causes these massive disparities when the EU is meant to be a customs union, you know, freedom of movement, whatever. But you can't have all that with the same monetary policy, because countries need to be able to balance according to changes, and they can't if the ECB is just setting it from Berlin, setting interest rate from Berlin. So, you know, it's one of those things where I think that the Eurozone's rigidity is really going to show. Over the next year or so.
No, for sure. And I mean, they've already put into place, I think they've essentially said, look, they will buy back bonds, or they'll bid up the bond market. And what you're talking about is the fact that the Eurozone really just tarnishes all the countries within it with the same brush. How can you do that when Italy, you know, we've seen the Italian bond market do some pretty crazy things, is going to have different inner workings than Germany, for example, or France, or any of these things. So it's kind of destined to fail, I think, the Eurozone.
Yeah, exactly.
That sounds, a lot of people are probably going to be pretty against me for saying that, but it's the truth. And if you look at what's happening in Germany specifically, not just Germany, I mean, even the UK, and you look at the energy kind of crisis that I think we're moving into, what are your thoughts on that? Because I think, bearing in mind we're in summer right now, you know, we spoke about CPI, we had the 9.1 CPI print for the US. I think we're going to get a lower CPI print on the next one. And I think this is going to fuel markets a little bit more potentially to see a little bit of further upside, because now they're going to go, okay, well, it's working. Maybe they are going to take their foot off the gas.
I don't know. I think that, you know, we're not going to quite get up to that 13.3%, but I've looked at my energy bills, for example. I was paying, how much was I paying? I was paying about 200 quid a month this time last year. I'm now paying 400 quid a month.
Yep.
Sorry, no, 500 quid a month. It was 400 quid last month, and it's set to go up to 650 or 700 quid by September.
What's an ITV report? Not that they're particularly a trusted source of information, but it was essentially saying that the energy bills that you've got, the energy increases that you've got coming this year, are essentially going to make it unaffordable for 10 million people in the UK to afford their utility bills.
Well, it's fucking unaffordable for me.
Yeah, this is what I mean.
You know,
and that could be a recession when people can't afford their. Talking about, you know, looking across the board, when people can't afford their energy bills, and relating this all back to markets driven on liquidity, what bullish outcome are you going to derive? You know, people are looking at this rally and they're going, all right, it's the start of a new bull market. Good luck, mate. Good luck. People aren't going to be able to afford their mortgages, let alone have the spare capital to put into markets.
No.
You know,
it's insane.
This is the thing. You spoke about this, the first interview that we did with each other. You spoke about Bitcoin going to 20k, and I think Bitcoin was around about 47k. I'll fish it out and maybe post it on Twitter.
All right.
what are your thoughts? I don't want to make your head any bigger than it already is, but what are your thoughts on the crypto market? Have you got any on the crypto market, or are you just kind of treating it as a risk asset class, which it's acting very much like, and just going to go with whatever the flow is there?
I still think we go lower. I
For
really,
sure.
really do. If we look traditionally at how low Bitcoin goes, it goes significantly lower from where we are now. That doesn't mean, though, that it doesn't go significantly higher in the future. You know, the only way for interest rates to go is lower eventually.
Yep.
And personally, I think the longer that it's able to hang around at lows, the more of an impetus it has. I wouldn't be surprised to see Bitcoin at 9K as the very, very bottom, pretty much.
Yep.
But who knows? We'll see. I
Yep.
think the fact that rate cuts have started to be priced out next year is quite significant. Only gradually, though, only a little bit. But from where they were sort of a couple of weeks ago, even last week, I'd still be concerned. And I think Mary Daly, what she was saying about markets being premature about rate cuts is bang on. It's
Yep.
really, really bang on. And it goes back to what we were talking about in the beginning, which is probably a nice way to end, is that people are forgetting about that inflation side of things. They think it's like the markets of the last 10 years.
Yep.
And it's not, when inflation is nearly double digits.
Perfect. Listen, David, it's been an absolute pleasure as always to talk to you. Very quickly, we'll leave all the links to your description. Do you want to give a little shout out to Macrodesiac, which in my opinion is well worth subscribing to? Like I say, David's one of the best macro brains out there.
Ah, cheers, geez. Yeah, just macrodesiac.com if you want to check out what we write. And yeah, if you want to join us, feel free to sign up. It's only 29 quid a month, or you can get it for, I think, 290 quid forever. We basically apply that price just to filter out idiots.
The chat. Yeah, yeah.
Do you know what I mean? It's like, it's one of those things where people are like, oh, paid group, blah, blah, blah. 290 quid forever is fucking pennies. I pay more than that in some subscription fees a month. So yeah.
Yeah, we'll leave a link.
If you like it.
We'll leave a link to all that in the description, and also David's social medias. Make sure you head over to his Twitter and give him a follow. Check out Macrodesiac. David, it's been an absolute pleasure. Thanks a lot for coming on, mate, and hopefully we'll speak soon.
Thanks a lot again, mate. Cheers.